This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Towards the end of our first lecture here when dealing with employment income, we spoke about travel expenses, where they were incurred by an employee in relation to the performance of their duties of employment. If they personally incurred that, that was an allowable expense. So as we said, if they had to go to visit a client that was 20 miles away and we went on the train, we'd have our rail ticket, and that therefore would prove that we'd incurred that expense. What, of course, may very well be the case is that when you do business travel, it's not just on a train, it's probably more likely in your car. Now, if you are provided with a company car, the business buys you a car for you to use, and that use will encompass both business and private mileage, then there is a specific way by which we deal with the assessable benefit. And that particular area, which is commonly tested in your exam, is awaiting us in just a short while when we turn our attention to taxable benefits, the provision by an employer of, as we call it, a company car there, then that will, in most cases, attract an assessable benefit. To want to be computed in a very precise way, but thankfully, all of the very fine detail that relates to that system is made available to us on our rates and allowances page. But not everyone is lucky enough to be provided with a company car by their employer. If, therefore, they need to go on company business travel and use their car, it is their car, their own car, that they use. So what we have here are approved mileage allowances. That if the employer reimburses you, the employee, at these approved mileage allowance rates, which we'll see in a moment, then there would be no assessable benefit so far as you, the individual, was concerned. If, however, the employer paid you more than the approved mileage rates, then that excess would be an assessable amount of benefit to include within your employment income. But what would also apply, and hence talking here about allowable expenses, if the reimbursement by the employer was less than the approved mileage allowance rates, then that difference between what the approved amount was and what has actually been reimbursed to you, the employee, that would represent an allowable deduction. So we need to know what these approved rates are and what happens if you're paid above that, or more specifically here, and with the example coming up, if you are reimbursed at a rate less than that. Again, we're talking here about the use of the employee's own car. It is a totally separate issue if the employee is provided with a company car by the employer. There will be, in most cases, an assessable benefit, as you would expect there to be, but that is something we discuss later. Okay, so what are these approved rates? For our tax year 2021, and they have been these levels for many, many years, the approved mileage allowance is 45 pence per mile for the first 10,000 business miles, and we're back to what do we mean by business miles, and then 25 pence per mile thereafter. Employees who use their own car, this is what we're referring to here, for business mileage, must use the approved mileage allowances in order to calculate either any taxable benefit, if, again, would be odd, but it might happen, the employer is reimbursing you at a rate higher than the approved mileage allowance rates, or it would represent an allowable deduction for you to take away from your employment income in any given tax year if the employer reimburses you at a rate lower than the approved rates. Either a taxable benefit, therefore, if you get more, or employees who use their cars for business mileage without being reimbursed. Now, the likelihood it is an exam question, there will be some reimbursement, but it won't be as high as the approved mileage rates. And that's what we're saying here, where the reimbursement is less than the approved mileage allowances, can use the approved mileage allowances as a basis for an allowable deduction. Now, in the example we see here, and it is likely in an exam question as well, you'll be told what amount of business mileage there is. In some examples, we are expected to compute out of a total mileage what is allowable business and what is classed as personal, and therefore will not attract relief using these rates. So what we know is you going from home to work each day, that is not allowable business travel expense. That is merely putting you in a position to perform your duties. It's not an expense that you incur in the performance of the duties of employment. So on that basis, home to work, not allowable. One place of work to another place of work, visiting a client, going to another office within the group of companies for which you work, all of that is fine. That is business. But just going from home to your place of work, no. There is one exception to that, and that is what we call if you have a temporary workplace. So you might have someone who works in the Birmingham office, and that is their normal place of work. Going from home to work, that would not be an allowable expense. If then they were seconded to the Coventry branch of their particular company, their employer, and that secondment required them then obviously to travel to work at that particular place in Coventry, that temporary workplace, if it's classified as temporary, the expenditure incurred in going from home to that temporary workplace, that is business mileage. That will attract relief. By temporary, we mean not exceeding 24 months there. That's what we mean by temporary. So, going to your normal place of work, not an allowable business expense. Going to a temporary place of work, up to 2 years there, 24 months, that is an allowable business expense. Going to a client, going to another office just on a day trip or whatever for a meeting, all of that is allowable business expenditure. Now, in relation to that business expenditure, if you are using your own car, then presumably the employer will reimburse you at their rates. Commonly in real life, these rates are the same as the HMRC approved mileage rates. In an exam question, they won't be, because if they were just the approved rates, there would be no assessable benefit, there would be no allowable deduction. So we're going to see rates that are either less than or more than the approved rates, and you've got to work out either of the two outcomes. Is there a taxable benefit or is there an allowable deduction? And that's what we see here, where a bit of a giveaway in terms of the requirement, compute the allowable deduction that the Kerry can claim. I think that Kerry can claim, it's obviously not just any Kerry, it's the Kerry here. That Kerry can claim against her employment income. So she uses her own car here. Now that's important. Whose car is it? It's her own car. It's not a company provided car for business travel. During 2021, she drove 12,000 miles in the performance of her duties. So here you're told what the business mileage is. Again, in another question, you may be told, here's the make-up of the total mileage for the year. Obviously, some of it will be specifically personal, private mileage there. Others it will be obviously business. And then you might get these other issues, like the temporary workplace. And you've got to establish, well, is that private, is it personal, or is that business travel? So she drove 12,000 miles in the performance of her duties, and her employer pays her 30 pence per mile. Now, obviously, 30 pence is less than 45 pence per mile, which applies for the first 10,000 business miles. But it is more than the 25 pence per mile that applies thereafter. So all you've got to do is make a comparison of what it is she is being reimbursed with, 12,000 miles at 30 pence, and compare that with what the approved mileage rates would be. So 12,000 would be 10,000 at 45p, followed by 2,000 at 25p. You work those out and compare that with, as we've said there, 12,000 at 30p. You will discover, obviously, that an allowable deduction will arise because the approved rates are going to be higher than the amount that she's being reimbursed. So over to you. You have a go at that, therefore. So pause for a moment. In fact, you may already have done this, maybe even in your head. But you crack that, check out the answer, and then we'll continue. And we'll be moving, as this question could have permitted, to move from allowable expenses to dealing with benefits. When we look at those benefits, some will be exempt. We'll deal with those first of all. Others, of course, will be taxable. It's then a question of the method by which they are taxable that you guys need to know and learn and be able to apply in an examination question. But just to deal with that one for the moment, please. Okay, well, having a look at the answer there, hopefully there was nothing that gave you any great problems. The mileage allowance that was paid by the employer for all 12,000 miles was 30p, so you were reimbursed with £3,600. The approved rate would have been, as we said, 10,000 miles for the first 10,000 miles at the higher rate of 45p, and thereafter at 25 pence per mile. That little lot comes to £5,000. So you've been reimbursed less than the approved mileage rates. So as the question intimated, there will be an allowable deduction. If the amount by which you had been reimbursed was more than the approved rate, for example, if this was 50 pence per mile, or 12,000 at 50p would be £6,000 would be the amount that you received. The approved, well, that hasn't changed, that's 5,000, so there would be an assessable benefit of the difference between the two, i.e. £1,000. So in this exercise, you could be computing either, as it was here, the allowable deduction, or as we've just seen, an assessable benefit. Well, having checked out the allowable expenses and their deductibility, we now turn our attention to what is probably the major learning exercise in relation to dealing with employment income. And that's looking at the area of benefits. Now, we start our checkout of benefits by looking at those that are exempt. Now, I'd imagine that there aren't many that are exempt. To think that HMRC have a great desire to tax anything that they possibly can. And to a degree that is true. But there's actually quite a long list here, and this is not a complete list by any stretch of the imagination, of exempt benefits. Now, in most cases, they're not something that amounts to very much, in all honesty. But again, something we need to know. As we said, employment income is eminently examinable, not just in Section A, in Section C. You could see the main part of a 15-mark income tax question involving employment income, looking at an employee and analysing each of the benefits that have been provided, which ones are exempt, which ones are taxable. If they are taxable, how are they taxable? As well as looking at the deductibility or otherwise of expenses there. So it could be 10 marks or more in a Section C question. So we start our analysis here of benefits by looking at the exempt benefits. Now again, it is a learning exercise. What you will need to do, of course, once you have studied this and I've taken you through it, is to have a go at some Section A objective testing questions. Once the chapter is complete, you'll be able to have a go at some Section C questions in relation to employment income. And when it comes to this area of exempt benefits, you may find, certainly in an objective testing question, that there may be the odd item or two that you haven't seen before. Again, I'm never going to tell you that in these brief notes that you're going to see everything possible. That's why there are study manuals available that run to several hundred, if not 1,000 pages there. And that's your reference book if you wish to look at it. Otherwise, you learn from the questions that you do. Oh, haven't seen that one before. I'll put an extra note of that one in. And so you grow your knowledge. Okay. First up here, Canteen. Well, what we're talking about here is a subsidised canteen made available to all staff. You may have different canteens. You may have one for The workers, one for the management, but as long as the level of subsidy is the same, it doesn't have to be exactly the same canteen that is provided. But subsidised staff canteen, that will be an exempt benefit. Qualifying removal expenses up to a limit of £8,000. If you're asking one of your employees to move from the London office to move to the Birmingham office, something that the individual would probably want to do anyway because it'd be closer to Villa Park and therefore able to see the greatest football team in the universe. But if they expect him to move, moving is expensive. So those removal expenses there may be covered up to a figure of £8,000, a figure that hasn't changed actually for many, many years there. Once that was a huge amount, now it's not so big. So qualifying removal expenses up to £8,000 if paid by an employer there when you're moving from one location to another location, or if you're joining a new employer to move to that new location there. If expenses, as they may very well be, exceed £8,000, like say 10,000, then you take away the 8,000. You would get the cover. You get the exemption on £8,000 there. Car parking spaces at or near your place of work. The company for which you work may have a company car park. Again, that is an exempt benefit when you're allowed to park as you would be free of charge within that car park. Surprisingly, but also true, the company hasn't got a car park, but there is a pay and display car park, one you have to pay for there, and they buy you a season ticket for that particular car park. Even that there, car parking spaces at or near the place of work would be an exempt benefit. Looking after your kids, so important, of course, there for young parents, usually, of course, young mothers, but workplace nurseries, or a creche as it may be known. Those two, exempt benefit. Now, there's our workplace. What you can't have as an exempt benefit is you take your own children to a private nursery and you get your employer to pay that private nursery or pay you to reimburse you for those expenses. No, it must be a workplace nursery, not just your costs for a private nursery are covered by your employer. Those would be fully taxable. Contributions, now here's an important one, by an employer to an approved pension scheme. This is something you'll see a lot more of in the next chapter, chapter 10, dealing with pension schemes. And contributions by an employer to an approved pension scheme, we'll discover in that chapter 10, there's two types of approved pension scheme. Occupational, one that is actually operated by the employer, and a personal pension scheme. And that is obviously by its very name, personal to that individual. Any such contributions by the employer to the approved pension scheme, those would be exempt benefits. To encourage, of course, us to get out of our cars and pursue a healthier lifestyle and a better lifestyle for the planet, workplace parking for bicycles, no less. Plus, gets better, a tax-free cycling allowance of 20 pence per business mile there. So as you pedal, you can get some money back indeed. If, of course, the employer chooses to compensate you in such a way. But again, a further exempt benefit. Provision of a mobile phone for your private use. Yeah, a phone, one per employee. Not that you'd need two phones, but if you were provided with, then the second phone would be taxable. How that would be taxable, we'll see when we look at the taxable benefits there. Here's a nice one. Christmas parties or whatever celebration the employer may seek to celebrate jointly with staff. Christmas parties, for example, for staff, up to £150 per person per year. It doesn't have to be just one party. You might have various parties there. You might celebrate every New Year, the normal years that we deal with, and maybe a Chinese New Year as well, wherever you may be based. As long as the total doesn't exceed £150 there, all of that is exempt. It doesn't have to be just in one individual party. Sport and recreational facilities available generally for the staff. Yeah, again, something that is good for the employee, something that is good for them to be doing to stay healthy, should be encouraged. If we don't encourage it and people aren't healthy, then they go to hospital, and that costs the government a huge amount in terms of the NHS. So these things are to be encouraged. Note here, though, sport and recreational facilities available generally for the staff. That is a company, say, gymnasium there and or swimming pool. This does not cover something that is available to the public. That is something for their employees. It's specific to them. You can't have, this is a general facility made available to everybody, but our employees get it free. The other people come in and pay. If your company paid £500 a year for a gym membership, that would be a taxable benefit there. That's not what we're talking about here. This is usually would be a large organisation, and they have set up at their place of work a gymnasium, and that is only available to employees. And on that basis, that would be an exempt benefit. An annual exemption of £500 per employee, where the employer pays for medical treatment, but note, to assist the employee in returning to work after a period of absence due to ill health or injury there. So it might be, I know you've broken your leg or something, and in order to try to get you literally back on your feet, they're paying for physiotherapy, something like that. Again, up to £500 per year to get you back to work. That would be an exempt benefit. We're not talking here about the company buying private health insurance, for example. If the company pays for private health insurance for you and or your family, doesn't matter, that is personal to you and your family, that is a taxable benefit. And the usual rules, of course, if they're paying £2,000 a year for you to have private health insurance, there's a £2,000 annual benefit. A type of health insurance that would be okay, maybe members of the sales team, they have to go away internationally to overseas countries in terms of their selling. And while they are overseas on business, the company pays for that health insurance, travel insurance there in relation to their health. That, again, is needed for an individual to go overseas and hence would be an exempt benefit. But just your basic standard health insurance in the UK, that private health insurance is fully taxable. Outplacement, there's a gentle word, sacking people. Outplacement counselling services to employees made redundant. The services can include counselling to help adjust to the loss of the job and to help in finding other work, for example, retraining courses, which could be extensive up to some 2 years. Again, something incurred there by an employer on behalf of the now to be made redundant employee, again, is looked upon as being perfectly reasonable, something to be encouraged in these sad circumstances, and therefore it's an exempt benefit. Contributions towards additional household costs, lightened heat, incurred by an employee who works at home, and that's up to £6 a week, or if higher, evidence must be provided by the employee to justify the expense. Just recently gone up from £4 a week to £6 a week there. Yeah, 2021. There'd be a lot of people working from home there. So that is something that's very topical, of course, there, given what has happened in 2021. Let's hope it's not the case in 21-22. Long service awards, up to £50 for each year of service. But what is long service? A minimum requirement of 20 years service. And here's a lovely one. trivial benefits, trivial, which do not cost more than £50 per employee and which are not cash or cash vouchers there. Again, you send to your employees a box of chocolates or a bunch of flowers or a bottle of bubbly, whatever, on their birthday or at Christmas, whatever, something like that, up to £50 for the year there per employee, that would be exempt. The use of employer bicycles, very keen on cycling as you've seen here, if used by employees to and from work. If they provide you with your cycle, then you'll get that as an exempt benefit. Again, all very good news for the planet and for your health, unless you get knocked off your bike, of course, by a car. Provision of eye care tests and or corrective glasses for employees using VDUs. And that is either if it's paid directly, whether it's paid by reimbursement to the employee or by providing vouchers. Yes, so many of us these days, not so much me, but spend time at a computer screen, and that has a deteriorating effect upon our eyesight, does it not? Well, again, provision of eye care tests, etc., that's something to be encouraged for the welfare of employees and is an exempt benefit. Incidental overnight expenses provided by the employer for overnight stays from home, up to £5 per night if that's in the UK, and up to £10 per night overseas. Classic one, you're overseas, all of those costs in relation to that overseas business trip have been covered. Your accommodation is covered, your meals are covered there. But what else? Well, that sort of £10 a night in terms of overseas, covering stuff like telephone calls home, for example. That one is one where, if those limits are exceeded, which in practice you would not, they become fully taxable. So you're overseas and your employer gives you a £15 per night such allowance. £15 is taxable, not 15 minus 10. So you'd stay within those limits. A couple of other ones just to look at here that I thought I might add in at this particular point. Benefits from third parties. We've been talking what your own employer does for you, but what about benefits from third parties? Now you think, why would a third party provide an employee of this other company with a benefit? Well, it might be, of course, that this member of this particular company is in the buying department, and whichever company sells to them, they like to be nice, as it were, to this individual. They want to try to, again, through networking and the like, look after this individual. Again, don't start thinking about bribery here. This is very much, again, looked at within the legal system. But benefits from third parties like entertainment, like you are provided with from a supplier with tickets to go and see Aston Villa, pause for due veneration, and a trip to Villa Park, free of charge. Well, of course, you'd jump at any such opportunity, would you not? Again, to see the greatest football team in the universe. Now, that would be an exempt benefit there. So, entertainment. Typically, it is sporting events that we'll be talking in terms of there. It's one that's widely used in practice. If it's not the provision, as it were, of a service, the gift of goods. Now, there we do have a limit, £250, including VAT, per tax year per donor. So there could be the provision of entertainment, there could be the provision, the gift of goods, and of course a very, very common one in terms of, not that there's much business travel these days, or at least as I speak, and for the last year there hasn't been much business travel, I know that personally, air miles. You get that, the company has bought your ticket to fly to wherever it might be, Malaysia for example, and on that basis you get air miles that you can use for yourself for a future partially free flight there or an upgrade. that is an exempt benefit there. Okay, so we have a number of, again, specific, explicit there, exempt benefits. Now, as I said, it's not a complete list. That would go on and on quite considerably, but your knowledge will grow, and there's a limit, of course, to what your knowledge could be. But practice, practice, practice is the order of the day. In fact, we haven't finished with exempt benefits as such, because where we'll be going to next, which will be, having dealt with exempt benefits, to look at taxable benefits. And those taxable benefits would be your mainstays like living accommodation. That's pretty substantial, isn't it? The provision of a car, the provision of fuel for that car. Go back to living accommodation, the provision of furniture and furnishings within that accommodation. All of this is very substantial. A beneficial loan there. They give you an interest-free loan for whatever it might be. In some of these areas, there are also exemptions. It is possible that when you're provided with living accommodation, that actually it could still be exempt. When provided with a particular car, it could be exempt. When provided with a beneficial loan, it could be exempt. When provided with, we're going down the scale now, a company van, it could be an exempt benefit there. But we cover that when we look at those taxable benefits, which will be up next. Again, though, for the moment, just have a quick look back through those, have a think about those. If you want to go off and do some, from whatever exam kit you've got, some practice Section A objective testing questions to get your head around the style and type of those questions and try to get that knowledge further ingrained in your memory banks there, by all means do. Otherwise, next up, we'll be looking at the taxable benefits. Okay, so we now turn our attention, therefore, to those benefits that are taxable. And again, a lot of work coming up here. It's not just a learning exercise, as was mostly to do with exempt benefits, although there were a few numbers in there. When we look at the taxable benefits, in most of the specific assets that are mentioned within this section of the chapter, there is a very precise method by which we determine what tax benefit there will be for our specific tax year. If we don't have any of those explicit ones being tested, then there is a general rule, and that is that the amount assessed is generally the cost of providing the benefit. So unless it's one of the ones that we see mentioned within the notes that follow, where this is how you do it, then if none of these apply, you fall back on, well, it's the cost to the employer. Another issue where in-house benefits are provided. For example, free air travel to employees of an airline company. The amount assessed is the marginal cost incurred by the employer. Now again, typical of that would be free air travel if you work for British Airways or whichever airline it might be. It could also apply, for example, if you work for a gymnasium company. And in terms of that gymnasium, you work there and you are, of course, then able to use the facilities. What you might be told in either of these circumstances is that the cost of the flight or the annual membership to general public to that gymnasium would be £800, but the marginal cost is only £100. You get the benefit of this as an employee free of charge. So although the resale price in relation to anybody else would be £800, the marginal cost of providing this facility to that particular employee is £100. You will have to work it out. They'll tell you what the marginal cost is. Then that is the figure you use. It's only £100. Now that is where you work for that company. Again, as we said earlier when discussing indeed exempt benefits, if your employer pays a separate private gymnasium your membership fee for that gymnasium, that is a fully taxable benefit at whatever is the cost to that company. Vouchers, exchangeable for goods and services, are less specifically exempt. Anything that we've been talking about for the last 20 minutes in terms of exempt benefits there, if you get a voucher for the provision of that benefit, then that too is exempt. Again, we said, did we not, that we may also see in terms of this list of items, stuff as we come to next, like living accommodation here, where there could be a very significant assessable, taxable benefit, where there could still be an exemption that applies. So let's look at the first big, significant item in terms of taxable benefits, but actually deal in relation to living accommodation, where there is no assessable benefit. And there will be no taxable benefit if the accommodation is job-related. Job-related accommodation is exempt. So what do we mean by that, job-related? You may have some ideas in your head already about this. Well, there's three categories. Firstly, where it is necessary for the proper performance of the employee's duties. And the typical one there, a caretaker. In order for you to look after, as the caretaker of a school, to look after that school, there is a living accommodation provided on site, so that they live there, they can take care of that particular property. That would be a good example in terms of necessary. To do this job, you need to live there. Well, you don't therefore get taxed in relation to the provision of the accommodation itself. It may not be necessary, but it may be for the better performance, again, of the employee's duties. And for that type of employment, it is customary for employers to provide living accommodation, for example, hotel workers. Now, not all hotel workers, but the hotel management. They, if you are the manager of that hotel, you again are required to be, as it were, on call 24/7. You might have a day manager, a night manager, you might have your general manager. But one or other or more of those could be required to actually live on site there. They've got a suite of rooms or whatever it is within the hotel. Now again, they're required to be there. That is job related. Now it's not necessary for them potentially. They could live just around the corner. But it is customary that, right, you're going to go to that hotel, you live there. We're now moving you to another hotel. You live there. It's customary for the better performance. And then, well, a very generic one, but where there is a special threat to the employee's security and he resides in the accommodation as part of special security arrangements. Now, they're not going to test you on, do you think this requires security? It is simply a fact to be aware of there. Now then, if the accommodation is not job related, which the vast majority of questions in this area will be, it won't be job related because there's nothing to do. It's just exempt. It's a knowledge-based question. But then if it's not job related, the benefit will be, now here we get into our calculations. There's going to be also some new terms that you'll need to become familiar with. The benefit is the higher of, firstly, the accommodation's annual value. Sometimes it may be written as ratable value. Now again, you do not have to know what these terms mean, where they come from. But the term ratable value and annual value basically derive from a system of local government taxation. All you have to do is to recognise the term, that the annual value stroke ratable value of this property is £5,000. There we go. We've now got that is a taxable benefit, that £5,000. But we're saying it is the higher of the accommodation's annual value or the rent actually paid for it by the employer if the property is rented. So, of course, the property in which the employee lives usually is owned by the company And that means we're talking about that one, the accommodation's annual value. But if it's not owned by the company, then it will be rented, in which case you now have to look at each of these two figures, the annual value and the rent actually paid for it by the employer, which in real life is always going to be greater than the annual value. So if it's rented, you look at the higher of those two figures. If it's not rented, clearly there is no rental, so you're left with it's that one, the annual stroke ratable value. This benefit is reduced by any rent or contribution paid by the employee there. So you're told that the annual value is £5,000 and that the individual has to pay £200 a month for the benefit of that living accommodation. £200 a month. This is an annual benefit, by the way, the annual value, the clue's in the name. So if you pay as the employee £200 a month to live there, if you're living in that property for the entire tax year, 12 times 200 is £2,400, and that therefore would be an allowable deduction against what would otherwise be that employment income assessment there. Watch out, as I've said, it is an annual value, so if you're not provided with that benefit for the full tax year, you, for example, you started a new job on the 1st of July 2020, and when you started that new job, you were then provided with this living accommodation, and you were obviously there in that employment for the rest of the tax year. Well, from the 1st of July 20 through to the 5th of April 21, that's basically 9 months, and therefore 9/12 of that annual value or ratable value is the figure that you'd be taking as the assessable benefit. And 9 months worth of rent at £200 per month would have been paid. So remember, these are, as so many of these benefits are, they are annual. If you haven't had that benefit provided for the full year, do remember to time apportion. That's a common mistake for students. Thirdly, there is an additional benefit, and this is where more proper calculations are now required, where the cost of providing the accommodation is greater than £75,000. The cost of providing the accommodation. Now, you would expect, of course, certainly within the UK, that the cost of providing that accommodation, where the company's bought that property for the employee to live in, then that is going to be significantly more than £75,000. So if, for example, the cost of providing the accommodation was, say, £200,000, then it's greater than 75, so minus 75,000, 200 minus 75 is 125,000, times, and again, that will be provided to you, this official rate of interest on your rates and allowances pages of information, 2.25% for the 2021 tax year. You multiply that, so 125,000 at 2.25% would be this additional benefit. But that only applies where the cost is in excess of £75,000. Now, what do we mean by that cost? Well, obviously, we start with the original purchase price of the property plus expenditure on improvements incurred before the start of the tax year. So anything that is in terms of improvement expenditure that took place during this tax year does not come into this calculation. So we are looking at the original cost. Maybe that original cost was £200,000, and having lived in it for a year or so or whatever, they then put an extension on, build a garage costing £20,000. Then in the year in which the £20,000 garage is built, that cost is incurred, you're still basing the annual benefit on the original cost of £200,000. From the next tax year, then it will be £220,000. If the employer bought the accommodation more than 6 years before first providing it to the employee, the property's market value when first occupied by the employee is used in the calculation instead of the purchase price. So, if therefore, when you moved into that property, the original cost of the property 8 years earlier had been £150,000, but the market value now when you move in 8 years later is £200,000. We've therefore got original cost 150, market value when you move in is £200,000 there. Then this rule applies. If the employer bought the accommodation more than 6 years before first providing it to the employee, so it doesn't matter years later how long you've been in that property, but when it was first provided to that employee, then what are we talking about? So here in my example, company bought it 8 years ago, somebody else has lived in it in the meantime, now you move into it 8 years later, the company has owned it for more than 6 years, what was the original cost? 150. What is the market value now? £200,000. Therefore, what goes into this calculation here is not the cost of providing the accommodation, but that market value when first made available there for that private use. That is the figure that you would use, and that in our example would be £200,000. When we talk about here the property's market value when first occupied by the employee, used in calculation instead of purchase price, but note that if the cost is less than 75,000, going back to this original point where there will be no additional benefit if the cost does not exceed 75,000. If the cost is less than 75,000, then there is no expensive accommodation benefit, irrespective of whatever that market value might be when you first occupied the property. So there is a company-owned property that's been owned by the company for 40 years. When they bought that property, it cost £50,000. They have not incurred any improvement cost on that property in between. Or if they have, it was like 10,000, 20,000, 50 plus 10, 50 plus 20, doesn't take you above 75,000. And when you now move in, 30, 40 years later, whatever I said there, and it's worth not 50,000, but £500,000, it's still exempt because that original cost plus any improvement cost in between has not exceeded that benchmark, that base level of £75,000. So that, therefore, would still be an exempt benefit. Okay. A little example, therefore, for you to have a go at now. Calculate the total benefit assessable on Jones for the 2020-21 tax year. Again, it will be provided to you on your fact sheet, but a reminder, your official rate of interest is 2.25%. What have we got? Jones, the sales manager, occupies a flat owned by his employer. So this is the figure you want. It is its annual value, 4,000. And Jones pays his employer £500 per annum for the use of the flat. The flat was originally purchased in 2008, that sounds like it's more than 6 years ago, for £100,000. And when Jones moved into the property in 2019, the property was worth £120,000 there. So we know it had been owned for more than 6 years at the time when Jones moved into it. Therefore, what do we use? Is it the old cost figure of 100, or is it instead the market value when it was provided for the employee's usage there? I think we know what that should be. So we have an annual value, always given to us. Relevant if, of course, and it's the only figure that's relevant, if it is owned by the company, so there's no rent involved here. But there is a rent paid by Jones, the employee. This is very different to the company renting the property on your behalf and then providing it to you. Here, any rent paid by the employee to the employer for the benefit of using the living accommodation, then that's an allowable deduction against the full benefit here, be it the annual value, or as here, the annual value plus, of course, the expensive accommodation benefit as well. So you need to establish what those figures will be. Have a go at that, please, and then check it out, the answer in the back. Next time, we'll move on to the other, again, very significant and explicit taxable benefits that lie within our syllabus. So much to do there. Probably the biggest of all of which that we will eventually come to will be cars. What we'll see in our next lecture, though, at the beginning of that, is when the company provides this living accommodation, they don't just say, right, there's an empty house, you now pay for your furniture and furnishings. It comes fully furnished. So what happens as regards any extra benefit as regards those furniture and furnishings? What do we do in those circumstances? The pleasure of that, plus at least most, if not all, of those remaining taxable benefits, awaits us next time.